This video is a step-by-step guide to constructing a journal entry. I'm going to start by going over a 4-step process for deciding what to debit and credit in a journal entry. Then we're going to walk through an example transaction using a sale of an iPhone X at an Apple store as our example transaction. First, let's talk about a process for deciding what needs to be debited and credited in a journal entry. There's a 4-step process for doing debits and credits. Step 1 is to pick one account that is affected by this transaction. Step 2 is to answer the question, is the account increasing or decreasing? Step 3 is to answer what type of account is it? Step 4 is to combine your answers from Step 2 and 3 to find out whether to debit or credit the account that you identified in Step 1. The table for identifying whether something is debited or credited is on the next slide, and it goes hand in hand with Step 4. Here is the debit credit rules table. We see all the different account types listed in the first column. Account types are asset, liability, equity, revenue, expense, and dividend. Whether a debit or credit is needed to increase the account is listed in the next column, while what is needed to decrease that type of account is in the last column. We are going to go through an example of using this 4-step process to do journal entries and determine whether something should be debited or credited. Let's go through an example now and construct a journal entry. Assume that on January 20th, Apple sells an iPhone X to a customer for $1,000 cash. Let's start on our journal entry now. We know that the transaction happened on January 20th, so we can put that date in there. Now to Step 1. Pick one account that is affected by this transaction. I'm going to pick cash. Cash is a good rule of thumb. If you see cash in a transaction, it's a really nice place to start your journal entry. Step 2 asks the question, is that account increasing or decreasing? Well, cash is going up because Apple received $1,000. So we have an increasing for Step 2. In Step 3, we have to determine what type of account cash is. Cash is an asset. We're going to combine those answers from Steps 2 and 3 to come up with whether we debit or credit cash. In Step 2, we said that the account was increasing, and in Step 3, we said it was an asset. So to increase an asset, according to our table, we would debit it. We now put our debit to cash in the journal entry and the debit for $1,000 in the debit column. But we're not done yet. We need the other side of this journal entry. Remember that every entry has at least 2 sides to a transaction, something given and something received. We will walk through the steps again to determine our other account. Step 1 is pick the other account that is affected by this transaction. Why did Apple receive cash? Well, for that iPhone it sold. Selling products would be sales revenue. Next, for Step 2, we ask, is that account increasing or decreasing? Sales revenue is increasing. Step 3 asks, what type of account is sales revenue? It is a revenue account. Now, combining those answers, we can see what we need to do for the second half of the journal entry. We had an increasing revenue account. So how do we increase a revenue? With a credit. In our journal entry, we would credit sales revenue for $1,000. Notice that the name of sales revenue is indented because it is a credit, and we also put the credit in the credit column. The final thing we need to do to finish our journal entry is to put the memo line in, which is just a quick description of what this entry is for. In this case, we can simply write, sold an iPhone X. Let's talk about the impact on Apple's accounting equation from this one transaction. Remember that the accounting equation is assets equal liabilities plus equity. Cash is an asset, so assets increase. Sales revenue is part of equity, so equity increases. Assets increase by $1,000, as does equity. The accounting equation remains in balance. I want to make two quick notes here. In real life, Apple records this transaction automatically at the point of sale when the sales associate enters it at the store and accepts the payment. We are also ignoring the cost of goods sold entry here. That will be covered later in the course. That concludes the step-by-step walkthrough of the construction of a journal entry. Journal entries are very doable. Just go slowly and methodically and follow the 4-step process I'd outlined. Have a great day.